Welcome back to the PNJ Group series on the FASB Conceptual Framework. Up to now, we have built the theory, the objective, the characteristics, the elements, recognition, and measurement. Now comes the payoff. In this section, we take 4 common accounting problems and run each one through the framework, step by step. This is where abstract principles prove they actually produce answers. Watch how the same disciplined path resolves very different situations. Let's put the framework to work. By the end of this section, you will be able to apply the element definition test to a real fact pattern. You will trace the recognition criteria through to conclusion and select the measurement attribute each situation calls for. You will explain the conceptual basis behind each answer, not just the rule. And you will see asymmetric prudence in action, the idea that liabilities and gains are treated differently under uncertainty. Let's start with the method we will use for every scenario. Every scenario follows the same path, and that consistency is the whole point. First, the element test. Is there an asset or a liability under the SFAC 6 definitions? Second, the recognition criteria. Does it clear all 4 hurdles, especially reliable measurement? Third, measurement. Which attribute applies once we recognize it? And finally, the conceptual basis, why the framework points this way. Here's the key thing. If you internalize this path, you can reason through problems the rulebook never anticipated. The 4 examples are practice for a skill, not just 4 facts to memorize. First scenario. Can internally generated research and development be capitalized as an asset? Let's run the test. Research may embody probable future economic benefits if it succeeds, so it brushes against the asset definition. But here's the problem. At the research stage, those benefits are highly uncertain, and the control test is shaky too. The entity cannot reliably isolate or hold onto the future benefit because researchers can leave and rivals can preempt a discovery. So the asset case looks weak the moment we press on measurability. That tension sets up the conclusion. So what is the answer? Under a SC 730, you expense research and development as incurred. There is a notable exception. Software development costs after technological feasibility can be capitalized under the software guidance, but that is a narrow carve-out. The conceptual basis is clean. The SFAC 5 measurability criterion fails at the research stage because the future benefits are too uncertain to measure reliably. Faithful representation then requires expense treatment rather than booking a speculative asset. This is the framework working exactly as designed, blocking an asset that cannot be faithfully measured. Second scenario. When does a warranty create a liability? Run the test. A warranty is a present obligation to provide future service, and the past event, the sale, has already happened. So the liability definition is satisfied. For recognition, you book it when the warranty is sold or included in the product. The sale has occurred. Future repair costs are probable, and the amount is reasonably estimable under the loss standard. Measurement is the best estimate of future warranty costs, using historical claim rates, discounted to present value if the obligation is long-term. Notice how cleanly this one clears every hurdle. Third scenario, and it tests your sense of timing. A company builds an oil platform with a legal obligation to decommission it in 20 years. When do you recognize the obligation? The instinct is to wait since the work is decades away. But that is wrong. Under a SC 420, you recognize when the platform is constructed because the past event creating the legal obligation, the construction, has already occurred. The 20-year timeline does not defer recognition. You measure at the present value of estimated future decommissioning costs using a credit-adjusted risk-free rate, and you debit a corresponding asset retirement cost to the platform, amortized over its useful life. Fourth scenario, and it reveals a deep asymmetry. An entity wins a lawsuit at trial, but the defendant has appealed. Do you recognize the gain? No. Under a SC 450-30, contingent gains are not recognized until all contingencies are resolved. You only disclose, and only if the probability of realization is high. Compare this to the warranty. A probable liability gets recognized, but a probable gain has to wait for near certainty. That is asymmetric prudence. SFAC 8, updated in 2018, permits this asymmetry as a legitimate expression of caution under uncertainty. Liabilities when probable, gains only when certain. Step back and notice the pattern. R&D failed on measurability, so faithful representation demanded expensing. The warranty showed symmetric recognition, the revenue and its associated obligation captured together. The asset retirement obligation turned entirely on the past event, recognized when the platform was built regardless of the distant payment date. And the contingent gain revealed asymmetry, caution applied more strictly to gains than to losses. 4 different answers, 1 consistent framework. This is the surprising power of conceptual reasoning. The principles do not just describe accounting, they generate it. Let's bring it together. Every scenario follows one method, element test, recognition criteria, then measurement, anchored back to the framework. R&D is expensed because measurability fails at the research stage. Warranties and asset retirement obligations are recognized when the past event occurs, even when payment is far off, and measured at best estimate or present value. And contingent gains wait for certainty, the signature of asymmetric prudence. Carry this reasoning into your own work, and the rulebook becomes far less intimidating. Next, we learn how to find the rules themselves, inside the codification. Thank you for completing this section on worked recognition scenarios.